Options Foundation Series. Lesson 6, Trade Call or Put Option. Hello everyone, thank you for watching this lesson. My name is Bala, and I put this series together to teach those who are interested in learning options trading the right way. If you came to this video without watching the previous lessons in this series, I strongly recommend you go back and start from the beginning. Each lesson builds on the previous one. And if you are not already subscribed, please go ahead and like and subscribe to my channel, NetNewUniverse, so you don't miss the upcoming lessons. So before placing an options trade, we must first decide what instrument we're trading and in which direction, bullish or bearish. Call options are for instruments that are expected to move to the upside. And if you're trading 0 DTE options which expire the same day, you must understand the risks and complexities, because most traders lose money. Options were originally created as a hedging tool to protect the underlying asset from volatility. That's why options are often more favorable for sellers than buyers. So before placing a trade, ask yourself, is the move really there? Is volatility making the premium too expensive? Is my risk defined and acceptable? Do I know my exit level? And is there enough time for the trade to work? Only when all of these align with your trade direction, you look for the option. Now let's walk through how to place an order on the Robinhood platform. Every trade begins with directional analysis. I log into TradingView and analyze the chart. This can take anywhere from 30 minutes to 2 hours. I do not take random entries. Trend comes first. When the trend is clear and the setup is confirmed, I move to Robinhood for execution. Log into your Robinhood mobile or desktop account. Any options-enabled platform will follow a very similar order flow. Search for the stock or index symbol you are planning to trade. When the details screen opens, tap or click Trade. From the menu, select Trade Options once the options chain loads. Buy call. So let's say your analysis determined to trade a call on a bullish stock symbol. Then, click on Call tab and Buy tab on the top of options chain. Select the expiration date based on your trade plan. Choose the strike price from the list. Next screen, click Buy. Now you are on the order screen. You set the number of contracts, choose market or limit order. If using a limit order, enter your desired price. Then tap or click Review. On the review screen, swipe to send the order. Your order will fill immediately if it is a market order, or get filled later when price matches your limit order. Once filled, you will see the position in your Robinhood positions list. Once you have a filled order, make sure you put the sell order. To sell, you go the option positions screen, then click on the position you want to sell, choose sell from the pop-up. The process is the same: set contracts, select market or limit, review, swipe to send. To sell, you can also use the options chain screen. Once you are on option screen, locate the option that you just got filled. Then, click Call Sell tabs and click the option row and follow the same procedure as the buy we just did before. If an order is still working and not filled, you can cancel it anytime, or replace it to modify price or details. While you are modifying the original order can still get filled if price reaches your level. So act quickly when adjusting. Execution is mechanical, the real work is the chart analysis and trend selection. This is the complete flow for placing an option order in Robinhood. Simple steps, but always follow your plan and manage risk. In similar fashion, you can also buy and sell a put. Only difference is you are working with an instrument stock that has a bearish outlook, and you are going to buy put to take advantage of the drop in the stock instrument, which in turn appreciates your options premium. At any time, you try to sell an option that is not already have a position for in your account, that creates a short sell, which requires capital, and those are called naked put call, which requires lots of capital to trade, as well as special options level approval for the same. Buying a call option is known as a long call, and buying a put option is known as a long put. When you buy an option, you pay the premium up front. The required funds are set aside at the time you place the order, and once the order is executed, the amount is deducted from your account. For this reason, a buy transaction is a debit transaction. When you sell an option, it is called shorting the option. This results in a credit transaction, meaning your account is credited with the premium received after the order is filled, minus any commissions and fees. Very important note. Keep in mind that if an option is not closed before expiration, there is a risk of assignment, but only for American-style options such as SPY, QQQ, and most stock options. If this happens, and the underlying closes at least 1 cent above the strike price for a call, or at least 1 cent below the strike price for a put, the option can be automatically exercised, and the shares will be assigned to your account. This means, for a call, you will buy 100 shares per contract at the strike price. For a put, you will sell 100 shares per contract at the strike price. The required funds for this transaction will be deducted from your account based on the exercised value. If your account does not have sufficient funds to support the assignment, your broker may issue a margin call, or your broker may liquidate the assigned shares to recover the cost. Any remaining shortfall will be your responsibility to settle. Some brokers, such as Robinhood, have systems in place to automatically close your open option positions on expiration day, typically about 30 minutes before market close, if you have not closed them yourself. Don't forget to like, share, and subscribe to my channel, NetNewUniverse, so you don't miss the upcoming videos.